Welcome back. You're watching Traders Corner, and joining me as always is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, it did it. The S&P 500 went to 2,500 points. In fact, actually breached or went above that. And you did talk about this magnetic pull that the level would have. And of course, unfortunately, that was very bad news for your option structure.
That's correct. So that's right. I mean, we said that the round figures tend to be like magnets for these markets, and so it was likely that the S&P 500 was going to go and push up to 2,500. It's now done that. The S&P futures today are trading above 2,500. So what that means is that our options position, which you can see the payoff on the right-hand side over there, this option position expired on Friday last week, and it's expired out the money. What that means is that it's basically expired in this red zone here where we lose our premium, which was $240. We had already accounted for that right up front, so it wasn't an issue. We said it looked in all likelihood that it wasn't going to expire in the money and that we would end up losing our premium. So it is what it is, not the end of the world. We have actually done another option structure, which we'll talk about later on this show, which takes us out to October and gives us effectively another month on in terms of some options exposure.
Yeah. Okay. Well, we'll get to that. But and the top 40, because the futures closeout is this week, and that's, I suppose, it's also going to end out of the money.
Very much likely, yeah. So we've actually, I've actually scrapped the position that was illustrated on the right-hand side here, which is the September options position. That only works for us below 48,000, which is there where I'm pointing it out with my mouse at the moment. So it's highly unlikely that we're going to see this market expiring below 48,000 come Thursday at lunchtime. So in all likelihood, we've also lost our premium on that top 40 options position for this quarter as well. Remember, 2 weeks ago, we spoke about entering a new option structure which runs out to the December futures closeout now. And I've actually shown that payoff on the right-hand side of the graph over there now. You can see quite clearly that works for us below 49,500 and all the way down to 45,000. So what I was looking at here is the potential for a bit of weakness into October, which we would then probably buy against using this options position as a bit of an insurance backstop, if you will. Just in terms of the technicals on the top 40 future, you can see the significant levels that we're watching for now are 50,000 at the upper levels and then 48,600 at the lower levels. The market has been pretty choppy and range bound over the last few days and really not much direction at all. And in fact, if you look at those moving averages there, that's a 15 moving average and a 5 EMA exponential moving average. You can see they're both tracking along sideways, which it tells you there's just absolutely no trend in the market right now, and it could go either way from here.
Yeah. Garth, I mean, just your thoughts on having both structures expire worthless. Obviously a bit of a blow and a bit of a frustration, although do you just say, well, they were my kind of hedge insurance anyway, so whether or not they expire in the money or out, there was a purpose to them.
Well, that's right. You've got to always go into a trade knowing what your possible outcomes are. And one of the possible outcomes with all these options positions that we do is that we lose our premium and that the position expires out of the money. That happens. In fact, the majority of options actually expire worthless, believe it or not. So, and we've certainly experienced that now with these last two positions that we've just talked about. Is it frustrating? This one, the top 41, is a bit frustrating in the sense that we were really well in the money in June and July, and of course it went right out of the money with that big rally that we saw into August. But it's not the end of the world. It's one of those things we know what we're in for up front.
Okay, so you talked about a structure that's, okay, before we get to that though, PSG, and I think that is frustrating because it was a trade that you entered into last week only, and you've already stopped it out. Yeah,
that's right. So here's the chart of PSG Group. We did this trade last week, and what I had identified at that stage, there was a longer-term uptrend that goes back to July 2016, further to the left of this graph. But that dotted line illustrates where that upward trend comes in. I saw the stock reverse up off of that trend line and also off the 200-day moving average. It was pretty oversold, so I figured that's an opportunity for us to buy it for a bounce back up to the underside of the 50-day moving average over there. So we went long with 300 CFDs at 242 Rand 15 with a stop loss at 237 Rand. Now, I actually got uncomfortable with this trade about 2 days after we went into it. And the reason being that, look at all those candlestick patterns down there next to the trend line. They weren't exhibiting the bounce that I was expecting off that support line. Rather, it was quite clear that there was selling evident at the upper levels. You can see on the long tails to the upside on each of those candlestick patterns that indicates that sellers are active at the higher levels. And with that, day after day after day, eventually I thought, this actually doesn't look like it's not doing what it should be doing. If the market was going to bounce, it would have bounced off of that level much harder. So I took a discretionary decision to exit the trade, and I did that at 240 Rand and 40 cents. So what it means is I cut the trade prematurely before the stop loss kicked in. Now, as it turns out, the stop loss would have in fact been triggered anyway. So closing it prematurely was probably the right thing to do. We did lose 853 Rand over here, so it's certainly not a lot of money. It's not even 1% of our capital at risk here. So it's fine. It's a bit disappointing, but again, it wasn't working, and you've got to know when a trade's not working, exit. They always say, get out of your losses quickly and try and run your winners.
And when you talk about, to some extent, there's probably a bit of gut feel there.
Yeah.
So I guess maybe the more experience that you have in the markets, you can kind of see things aren't working out quite the way you want them to.
Well, that's it. That's exactly right. And there was gut feel here, and I just looked at it and I said, it's just not doing what it should be doing. If the stock was really going to bounce off that support level as I expected it to, it should have shown more enthusiasm, which it didn't do, and I took that as a cue to be aware that the likelihood is actually that it was probably going to break down below that support, which it has now done.
One does hate an unenthusiastic trade.
Yeah.
All right, well, talking about enthusiasm, your enthusiasm for option structures is not dimmed by this year's or the last couple of months' events. And you've initiated one for October expiry. That's quite a short expiry, isn't it?
Yes, this is a very near-dated option structure that I've done here. So it's another put spread option structure. It's on the S&P 500, and it expires on the 20th of October. So that's just over a month away. So I'll go through the thinking behind this trade. It is a bit different because normally we do these structures with 2 to 3 months out. In this case, it's a far shorter dated structure, which makes it interesting. So my thinking here is that the S&P 500 is still very much in this upward channel that you can see illustrated over there by those two parallel lines joining the boundaries of the trading action since April. But what's interesting to note is that there are a number of gaps in this S&P 500 chart, but they always seem to get filled. So there you have a gap up in late April, which was then filled again in middle of May. Then later on, we had a gap up in May, which was then filled in late June. Then we had another gap in early July, which was filled in mid-August. Now, the other day, about a week ago, we saw a gap up on the S&P 500 again. And that comes in at around about 24.65 or there and thereabouts. That gap hasn't been filled yet. And my expectation is that we probably will see something similar to what we've seen on all those previous situations where the market moves up, but then it begins to just come off and consolidate a little bit and pull back, fill that gap, and then possibly get going again. So that's the one thing that's got me interested here. The other thing is that if you look at a seasonality chart of the S&P 500, this is a chart that looks at 20 years worth of seasonal trading history on the S&P. And what you can see is that the first quarter of the year is generally fairly strong. Then you have these quiet months through the middle of the year. August into September and October is quite weak traditionally, and you have the spike seasonally, a spike in mid-September followed by a drawdown in October. So we've actually seen a bit of a spike in September at the moment, right? You can see that at the end of the graph over there. If we are to see that seasonal pattern unfold, then I think it also talks to the fact that we could come off a little bit into October, which is a seasonally weak month of the year, and it could very well come down and close that gap that I've highlighted over there. So I'm basically looking for an option structure, a near-dated option structure, which will give us participation on any near-term pullback. And I'm not looking for the market to collapse here. I'm just looking for it to retrace a little bit from these levels and come back down towards the lower end of this trading channel. So if I can get something that's going to benefit us from about 24.60 and downwards, that's what I would be happy with. And that's what I've sought to do with this put spread structure that we're going to talk about now.
Okay, well, take us through that because it is fairly complex.
It is. So it's the same thinking as all the other put spread structures that we always do on the show, but I'll quickly explain. Along the bottom axis here, we've got the different levels of the S&P 500. At the moment, we're sitting at 2,500, so that's more or less at the money where my mouse is there at the moment. And then on the left-hand side here, we've got profit and loss. So there's your zero line. Above the line is profits. Below the line is losses, measured in US dollars, right? So the first leg of the structure is what I've done. I've gone long of a put option with a strike of 24.90. I've done 5 of those, and the price there is $21. Now keep in mind, each option here represents $100 per point. So in effect, you've got to take these numbers and multiply them by 100. But what that means is that I've paid away a premium of $1,050 for that option structure, and it then makes money below 24.90, and it continues to make money. The lower the market goes, it'll continue to make money all the way to zero. Now, the market's not going to go to zero, certainly not by the 20th of October, or ever for that fact. But so what we'll do is then sell away some of the downside participation in order to try and recoup some of the premium, because me paying away $1,050 for that option is quite a lot of money in terms of in terms of the capital we've got available to us. It's quite a lot. So what I've then done is I've gone short of a put option with a strike of 24.60, and for that I receive $13.40 per option. I'm receiving a premium of $670 here. Right, so you can see that payoff is illustrated with the premium line above the zero line, and then that will start to lose money below 24.60. Further out, I've sold short another put option, a further deeper out the money put option, with a strike here of 22.90. In fact, is the strike level. There's a typo on that slide. So for that, I've received a premium of $13.40. And I'm receiving $140. There's a typo on that slide. I apologize for that.
Okay.
Anyway, look, let's just sum it all up. And that dark blue line is an illustration of what the payoff profile would look like with all three of these legs overlaid against one another. So here it is. You can see above 24.90 effectively, I pay away a premium of $240.
Okay.
It's just a coincidence that that's actually the same amount of premium as the prior structure that we've just closed out. My maximum profit is achieved below 24.60 and all the way down to 22.90 on this structure, and that allows me to earn $1,260. So that profitable zone is pretty broad over there. You can see it makes me money all the way from about 22.50 up to 24.60 odd. It's a very broad profitable area. And if I just overlay that and I think turn that thing on its side, this is what our payoff profile now looks like when we overlay that onto the S&P 500 chart. So you can see above 24.90 effectively we lose our premium of $240. We accept that. We know we've accounted for it already, in fact. And then if we go down to 24.60 or below by the 20th of October, then my maximum profit that I can generate is $1,260 on this trade. So if my thinking is right, then we could see ourselves moving into the sweet spot by that date. And if I'm wrong, worst that can happen is we lose our premium, which is $240.
And if the market, I suppose, starts looking really strong, you could always go long against it.
Yes, I could. Ideally, I would want to see it come back towards the lower levels here before I go long, because then I can know that I've got that options protection in the background.
Garth, very, very quickly before we wrap up everything, the fact that you've got a 20 October expiry date, is that sort of more possible with US options than, say, South African options? Because you've got those quarterly expiry dates, which kind of lock you in and you don't know what's going to happen for 3 months.
Well, that's it. So the overseas options markets are so much more developed than ours. In fact, the S&P 500 has an options expiry every week, believe it or not. We only have them every quarter here in South Africa, so we're far behind and we're in the dark ages as far as this stuff is concerned. And I would say for viewers that are interested in options, I mean, I find these things fascinating, and I'm planning to make more and more of my personal trading career in the options space. The overseas markets are really an interesting place to do it because there's so much more liquidity. They're on screen and you can trade them in small size, which you can't really do here in South Africa.
Yeah, and I'm sure that if you go into Traders Corner, I guess there'll be a discussion on you know, how retail investors go about this.
Yeah.
Unfortunately, we have to wrap up, so just wondered what the portfolio looks like, given that it wasn't necessarily a great week.
It wasn't a great week, so I'll quickly take you through both. Here, our South African portfolio is up 7.5%. We lost a bit of money on PSG Group there, and then offshore hasn't been a great week either. Our Unilever position's been coming under a bit of pressure because of the strength in the pound.
Yeah.
So we've come off a bit there, and then of course we're now accounting for that option premium on the new structure that we've just discussed. So we're down almost 8% for the year to date overseas at the moment. So certainly not looking too good overseas.
Okay, Garth, we have to leave it there. And obviously people can watch the show again and also on the website. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.